Good afternoon, ladies and gentlemen. Thank you for being here today on day 2 of GITEX Global here at the North Star Dubai 10X stage. It's wonderful to see you all here. We have had a very jam-packed morning right here on this stage with some very exciting path-breaking announcements that if you were here, you would have seen the signing ceremony for GITEX making its way now to Morocco. Lots more coming up over the next few days of the show. How many of you were here for day 1 of GITEX? Oh, a good chunk of you. How many of you were here at this stage yesterday? Okay, a few. So in brief, yesterday a lot of our discussions tapped into funding and what makes basically the funding beast work. How does it play out here in the region, especially after what we've seen happening in markets around the world? Are we seeing investors here mature in their appetite, mature in their interest, and the kind of checks that they're writing? Today, however, a lot of our discussions cover growth, not just growing in the region, but how do you make growing across sectors and across countries when you're based right out of the Middle East? How do we make that work? We have yet to see a multi-sector, multinational tech giant coming right out of the Middle East that isn't a carbon copy of an idea we've seen somewhere else. So to start on this very topic, I'd like to welcome the members of our first panel this afternoon. This discussion on how growth stage investing is disrupting the venture ecosystem will be moderated by Faris Ghandour, a partner at WAMDA, who's been an active investor in the tech startup scene in the region for the past 8 years. He's also co-founder and CEO of Touhoun, a mental health startup that aims to make the Arab world a happier and healthier place. He will be joined by Amal Dukan, general partner of 500 Global, and Benedetta Balducci, head of portfolio and client solutions for EMEA at Hermes GPE. Welcome to the stage, Faris, Amal, and Benedetta. A round of applause, please, ladies and gentlemen.
Nice to see everybody. Thanks for taking time. Some familiar faces, which I like. I think we get started with a quick intros. I'd like the panelists to introduce themselves. Benedetta, maybe you start.
All right. So, first of all, thank you, GITEX, for the invitation, and good afternoon, everyone. I'm Benedetta Balducci. I'm the head of portfolio and client solution for EMEA for the private equity division of Federated Hermes, which is a global asset manager with roughly 630 billion AUM. We have a global program, and we are co-investors as well as fund investors. So we run co-investment funds. We run hybrid funds with fund-of-fund components and co-investment components, as well as early-stage funds with the same structure.
Amal?
All right. Well, good afternoon, everybody, and it's so great to see everyone here. I'm a general partner at 500 Global. I manage the MENA fund, and 500 Global is a global firm that manages, also 2.7 in assets under management, and we have multiple funds around the globe. We're sector agnostic, but we also started to focus, in certain sectors as well, and we do early stage all the way now into growth, which is something that we started to do as our founders evolve, in their journey. Very excited to be here every year in GITEX, so I'm very nice to actually have you moderate this session for us.
Thanks, Amal. So I'll quickly introduce myself. I wear a primary hat and a secondary hat. My primary hat is a founder. I founded a mental health business called Touhoun in the very early stages now. So I did jump from being an investor to a founder, which has allowed me to become much more empathetic, which is a trait that I cherish now. My investor days, I started investing in 2014, writing small 250K checks in companies in the Middle East and North Africa, as well as some fund of funds, all the way through to Series A at WAMDA Capital, all the way until today. We are a bit atypical, so we did manage. We have a fund, the traditional kind of GPLP structure fund under management, but today we're more of an evergreen type structure, so it gives us a lot more flexibility to write different forms of checks in different companies. So the title of today's panel is sort of, I guess, how growth stage financing is disrupting the tech ecosystem. And I'll maybe start with you, Benedetta, and ask, you know, should we look at growth stage financing as disruptive? How would you frame growth stage financing in the tech ecosystem here and globally, and how do you kind of juxtapose the two against each other?
So that's a very interesting question. And funny enough, when I look back at when I personally started working in private equity, roughly 14 years ago, there was kind of a very clear cut between what was private equity, whatever the stage, and what was venture. So it was very clearly defined, and funds were kind of clustering into the two environments in a very, very, cut off way. Over the years, and especially I cover EMEA, so I happen to discuss yearly with 150 to 200 investors across the region. And if you ask right now, which bucket of capital would you use for a specific opportunity, being it a company or a fund allocation, most of the times they will be kind of panicking. It's very blurred. There is, I would say, it's a gray area. And that is, I personally believe, because the two strategies have over the years expanded horizontally. So there is much more within the scope of venture and within the scope of growth investing. So when you ask me, is there competition, is there disruption? I absolutely don't think so. I think that growth capital goes into the support of venture investing, and it gives alternatives for those companies that don't happen to turn into unicorns and go IPO in 18 or 24 months. And they need more institutionalization. They need more support into a growth stage, which is a step-by-step approach rather than, a flip it up and go public. So I absolutely think that those two words are complementary. And it is key for players like us, which are multi-strategy and multi-fund players, to be very close to the venture ecosystem, because a lot of opportunities, especially with our earlier stage fund, but also with our core flagship fund, will come from the venture space and its evolution. So no, I think they are two strategies that are highly complementary, and growth stage will absolutely support making some venture-backed companies very solid companies over the years.
Yeah. So the way I like to sometimes think about growth versus venture stage is not ticket size, right? So you can have a $500 million venture check in a company that's growing, but you can also have a growth type PE check that's $50 million. And the way I sometimes kind of think about the difference between PE and VC is not so much stage, but the style of investing, the approach. PE tends to come in and maybe be a bit more controlling. They tend to have a bigger say in management. They do a bit of restructuring versus venture, which is more laissez-faire. And I think if you observe kind of what's been happening at least the past 4 or 5 years, you can't get away with raising a PE fund now without having a tech mandate. But now it seems like, from what's happening with you at 500, Amal, it's also the case now that earlier stage funds are doubling down by doing growth stage. And I think there's multiple reasons for that. One is more conviction, so doubling down on the winners to give your LPs more upside and absolute value rather than necessarily on a multiple basis. And you see all kinds of different strategies around that. You can see, I don't know, an opportunity fund being launched on the side. So maybe you can tell us your perspective, Amal, about how you got into growth from, how you started from early into growth. Yeah. What does that look like? What gave you the conviction to do that?
So I'll tell you about that, but just following up also on that, it's a very exciting point, because I've been looking at pre-seed and seed for the past 10 years. And literally, we've seen the evolution of funding and how founders actually think of fundraising options, right? And at that time, PE was not an option for an early stage tech company that doesn't have that, validation, doesn't have profitability, is still starting in a testing market and all of that. And over the years, we started to see the increase of liquidity in both, VC, and then we still need more PE, I have to say, in the region, and more maybe success stories with tech companies and private equity in the region, because that's what's going to build that conviction that founders can start looking at that. VC can also start at private equity as one of the options of shaking hands, and looking at deals, at a certain point together. But what's really interesting, and I'm noticing that in the past 2 years, there are certain sectors in tech that are much more attractive to private equity, as you said, but two are actually happening in some of our startups in insurtech and health tech. Because some of the private equity institutions that are looking into that, they're looking for consolidation. They're looking for these amazing tech players that are disrupting these markets that haven't been digitalized or haven't been connected, so they become super attractive. Now, going back and reflecting at 500, 10 years or 12 years of investing in early stage, utmost conviction in founders. We've seen the journey, we've seen the exits, whether to IPO or whether through M&As, or even, other options of kind of liquidations. Nowadays, it's about time that we double and triple and really continue that journey. And because we didn't have these growth funds in the early stage, 500 actually got into a B or a C round through SPVs, and really allowing those LPs to take a role, in that success story where we have more conviction, and we have more numbers. So I think we tried over the years just to be part of that evolution in different ways, and now it's time where we're preparing to get into, the growth financing, round. So hopefully a lot of good news in MENA soon.
Excellent. So maybe just on that point, you have your 500 and Sanabil. Sanabil is a kind of later stage fund in Saudi, and obviously 500. You being in Saudi, you focus a lot on that market.
Yeah.
So are you saying your growth stage mandate now is besides Sanabil? It's an independent growth stage mandate for 500.
Very good question. So our partnership with Sanabil comes in the form of, they are actually our partners in the accelerator fund. So they allow us, because today we invest in two ways. I think it's been historically known that we invest through accelerators only. Today we invest through also another part and reserve part of the fund in opportunities in direct manner. So it doesn't have to be through the accelerator. We sort of assess the stage of the company and we want their best. So we direct them to which route they can benefit from, because the accelerator is all about growth hacking, experimenting, access to market, pushing and pushing, especially to the ones that want to access Saudi Arabia or want to access Egypt or want to access the region. And the good thing, 500 has the network in all of these countries. So we literally try to assess and understand and push you towards that right direction. That's definitely, we want you to stay and be really useful, in that kind of track. Our partnership with Sanabil is about setting up that fund. We started in 2021. Now we are in batch 4, but we also have done about 5+ direct deals as well in that time between pre-Series A and Series B. So that kind of a bit, of a game changer. But yeah, whatever we're doing is, Sanabil and Saudi Venture Capital are our limited partners, basically. So
Excellent.
Definitely another thing coming in the route. But they support us when the company reaches Series B, obviously.
Nice. So I think the interesting thing about having you both on stage is, on the one hand, as much as I believe we need foreign funds or international funds to come to the region, I also believe that there's very much a need for, especially in today's world, of building a regional and domestic ecosystem from the ground up, which I think is what you're doing. But maybe to direct the question to you, Benedetta, which is for a kind of, I think you have 6 or 7 billion, AUM as a PE fund. Maybe you can tell me a bit more about what you look for when you look to invest in an ecosystem at the growth stage in emerging markets, and what does MENA have and what does it not have for you to start investing more proactively in the region?
That's super interesting, and I have been an incredible supporter of the internationalization and the globalization of private equity. And I actually started with investing in growth capital in Southern Europe, which is still less mature than the rest of Europe, as many of you may know. So our fund, and I'm talking about our flagship fund, has a hard cap of 600 million and is currently raising. And it is by far the most global of all co-investment funds in the world. And when I say that, it means that we can go up to 30% of allocations outside Europe and North America. All our competitors never ever go over 20%, and there is actually only one player that stretches to 20%. So we technically and regulatory have the opportunity to invest in this region. Where do we invest at 30%? We invested in Asia with a pan-Asia approach. We are very strong in South Korea. We have done very good deals in Malaysia, in Indonesia. So there is no way that prevents us from investing in this region. But what is it missing? So we are growth investors, and we kind of discussed what growth means, right? So there should be an ecosystem that nurtures companies and bring them to that stage in which we are able to obviously access the company, add that institutionalization, provide that international network, and kind of escort the company to the next phase of growth. When you look at this region, unfortunately, there is incredible focus on the earliest stage, as obviously Amal just mentioned, and very few on the next phase of growth. To the point that Amal herself mentioned that they had to find their own firepower to cover that stage of growth. So I believe that there could be hundreds of opportunities for large players like us that are focusing on the mid-market. So we focus on small companies. The median enterprise value is $200 million. So really small companies, if you look at them. But we need the local players and the sovereign funds, obviously, and the local support to create that ecosystem to kind of give us the chance to be players in the region. And when that will happen, even, for instance, by those players investing in us and using that capital and that money to push, to address our interest to the region, I'm absolutely positive that we could start and, kind of play a role in this region as much as we have played a role in North America and Europe and the rest of Asia over the past 21 years of co-investing.
Yeah, great points. And I think maybe to add a couple of points to that, many of you may know that the PE ecosystem in the Middle East was a lot more mature before a big incident occurred a few years ago, which is the Abraj failure. And I think that really held things back here much more than a lot of us might imagine, and affected the entire kind of cycle of the of the cradle to grave ecosystem, if you want to call it that, because it made people much more averse to doing PE in the region, oversight, governance, that sort of a thing. It raised a lot of questions about the business model of PE globally, frankly. A lot of warranted points, how do you build leverage? How do you do leverage buyouts? So I think that incident really held us back. But there is certainly a trend now towards building that back up, and I think kind of rolling up our own sleeves and doing that ourselves, which is, I guess, what 500 is doing, and we need many others to do the same. And we are hearing of other funds raising as well, sort of growth stage funds, parallel funds, which is very admirable. But I think the equation starts to differ at the growth stage because it starts to become about liquidity, right? So who comes in and acquires after? And I think, the UAE have done a great job here at the DFM, sort of NASDAQ Dubai specifically, actually, which is they're kind of really pushing for tech listings. They're focusing less on sort of 3 years of profitability, that sort of a thing. The same with Saudi. Obviously, we have Jahiz on Tadawul, which has excellent multiples by any standard and has managed to maintain that level. So there is more, money coming in at the capital markets. But I do think, as much as early stage, and I consider early stage being tech growth stage as well, so up to Series C, let's say, financing, as much as there's a lot of excitement around that, it would be nice to see some more M&A activity. So, I'mar did Namshi, and a couple of others in Saudi as well acquired some players and did bigger checks. I think that's necessary as well. You can't just depend on capital markets. So maybe I shift gears a little bit and ask you, Amal, about trends. You're probably the most active early stage investor in Saudi, so that by definition makes you the most active investor in Saudi in tech. There's a lot of volume. Things have slowed down globally and maybe not so much so in Saudi. Can you tell us what you're seeing, what's promising, what's scaling well, what you're looking at, what excites you for the next year or two?
Definitely. Always excited, by the way. Yeah,
Good.
anything that's venture and tech, definitely we're up for it, and we're ready to talk about it, and see the possibilities. I think, one of the exciting parts that we can also look at now in the region in particular, and definitely Saudi, there's a lot happening. We look a lot in North Africa, in the Middle East, but with our presence, we're also closer to the network in Saudi. I think one of the things that we're seeing, especially after, last year, definitely the valuation story was always the word in town, about the high, valuations that are available in the market. That is becoming, a bit different today, where there is more conversation. We're looking at, better valuations, and the founders are actually more kind of aware of, why would I set that, at what stage, what are the implications on my company if I do this. They're looking for more value add, and that is something few years back, it wasn't a thing that you would look out or hear. Like literally in my meetings, in my, kind of things, and when I said with the founders is like, I want to know what you can add, on top of the money, or I hear the statement, it's not about the money, because there's a lot of liquidity in the market. So now they're becoming more, who's strategic and who's not, and what do I need to do in order to get that investor. Hopefully it will evolve to a more of a partnership, between VCs and between founders, because we're in it together for the long term, right? We're in it there. We try to be available. We manage big volume of portfolios, as the nature of our, investment. And that actually puts a challenge, but it also gives us an advantage to look across boards, and really have the right relationships in corporates and in others, right? The trends, I'm seeing a lot of B2B, honestly, now. A lot of shift. When I look at my portfolio last year and this year, some of the current batch is like, we've got about 15 companies, 14 of them is B2B SaaS. So that to me is actually telling a lot about what's happening in the market, and that enterprises are becoming more mature working with tech companies. They're allowing more pilots, taking more meetings, getting more excited, and even calling us to ask, do you have anyone in this and that? Second thing, I would call it mature founders, come with experience of 5, 10, 15, 20 years out of their, sectors, and they're starting tech, companies. And that is another interesting thing to see, because they come and they say, we've got the network, we've got the bandwidth, it's about how do I scale? How do I take it to them? I see you smiling because you must be relating to what I'm saying. So it's about a different type of value that we can add. So definitely in terms of sectors, Fintech still keeps, rising. We've done a couple of Web3. We're seeing a lot of things in, in blockchain, but not so much. Literally, Fintech is dominating, I think, the scene at this stage. InsurTech popped up last year. Health tech is becoming a thing where some of the hospitals are looking into more digitalization and other. But in general, I think we have to be optimistic, we have to act that way, and we have to keep supporting, because liquidity is still in the market. I need founders, if there is any in the room, push for it, go to your value add portfolio, kind of investors. And at the end of the day, this is your time. It started 2 years ago. There might have been a hustle last year. Do it. I'm positive that this is going to get better and better. The signs are there. Probably the global scene is shaky, a bit into that. But it's the right time in the region. So if you don't
absolutely.
do it,
There's still a lot of liquidity, I think, at the
a
early
lot,
stages,
actually.
especially.
Magnet reports reflect the numbers. You can take a look at it. Definitely.
Absolutely. Benedetta, what are you seeing globally? What's going on?
So we are technically a generalist investor. So we could do anything. We kind of stay away from asset-heavy industries, and that is for a number of reasons. Obviously, risk in the underlying asset, but also it comes with, asset-heavy industries comes with a lot of pollutions, and we obviously want to be net zero. So that is one of the reasons why we kind of stay away. However, before coming to stage, I checked the statistics of our current fund, and even if we are generalist, 58% of the fund is currently invested in IT and digital related sectors. Now, that increases to 63% if you look at what we call accelerating digitalization, which is one of our themes. We like industries, even if mature, those industries that have kind of endorsed the digitalization process to become more efficient and more effective in their normal production processes or distribution processes. So 63% of our portfolio, of our flagship fund, is today into these sectors. Now, have that changed? If you look at over the last 12 months of investing, and today we launched the fund in November last year, mid-November, so we're almost 1 year in life of our 5th generation fund, and we already have 14 companies in the fund. So we have been quite deploying quite a lot of capital this year. The first part of the year, it was absolutely towards B2B, software, SaaS. Now we're seeing a lot of pipeline into healthcare as well, a little bit of education, and how digitalization and tech can enable an improvement in the effectiveness of education and its delivery. And we're looking at that quite interestingly also in the US. We closed a deal very recently. So there are a lot of opportunities there. What I would say was the main shift is not really in sector itself, but more into the mantra. Over the past years, there was kind of this mantra of growth at all stage and at all cost. And we are growth investors. So our median growth rates of our flagship fund is 26% CAGR. So we are growth investors. However, I do believe the mantra shift towards more profitable growth. We want to see that path towards profitability, and we want to see profitability growth and top line growth at the same time. And that's the reason why we want to come in as investors, to help that, to make sure that also that part of the income statement is well taken care of.
Fantastic. Yeah, I think overall, same with WAMDA. I think the leaders were consumer tech, mobility, and the laggers, which are now growing, are fintech, health tech, and ed tech. And I think the common points between those three are they're much more regulatory heavy. And I think it took a while for the regulators here in the region to wake up. And now that they are, as you mentioned, a lot of money is going towards all three. So very exciting to see what's coming next within those industries and beyond. I'm not sure how much more time we have. We have time? Okay, lovely. All right, let's do it. So I want to talk a little bit about geopolitical risk. Frankly, I saw that question and I try and avoid it, and that's why I kept it for last, because this is what we live and breathe. We don't know what geopolitical risk even means. If there was no geopolitical risk, I think we'd have a lot more foreign capital here. M&A would be less appealing. Foreign entrants coming to our markets would be much more of a common thing. So there's two sides to it. On the one hand, geopolitical risk is actually a barrier to entry. But on the other hand, it's also a barrier to scale for local companies. So Benedetta, how much of your, I don't want to call it reluctance, but how much of your mandate to do broader Asia hasn't included as much MENA so far because of perceived geopolitical risk.
So first of all, I want to share how we do cover the geopolitical risk as a firm, because
Sure.
I think it's quite interesting to really understand the reason why we have avoided some countries over the past 12 months and the reason why we'll double up on other countries. So we have an internal committee made of research analysts that every 6 months or every 12 months, depending on the geopolitical situation, gets together and kind of educate the investment team of what are the real geopolitical risks and how much our risk return profile would be affected by it if we will to go in a specific country. At the beginning of this year, you all know, obviously, the political decisions of China, the zero COVID policy, for instance, that had a dramatic impact on all the growth predictions of the exports, movement of capital, and so on and so forth. Mainland China was under our radar before. We've been extremely cautious over the past 12 months. We did close one investment, but how did we do that? We checked that the fundamentals for growth of the company were there irrespective of the geopolitical setting.
Or because of.
No, it's not really because of. In this case, it's a pest control company, so obviously the dynamic is more internal demographic growth, which is still there. People are moving to cities, and it's still true even in a no-COVID world, in a zero-COVID world, right? So my point is, I haven't seen any red flag on the MENA region from our internal committees. So I don't think that's the main reason why we haven't looked at the region yet. I mean, we had done a couple of investments, to be fair. But what I think it's the main reasons why we're not really strong in this region is because we are incredibly selective. So our selectivity rate since inception is 6%. So we convert 6% of the companies that the investment team reviews. And for our flagship, we review like 620, 650 every 12 months.
Yeah,
right
that's
now,
much higher than it is for venture, by the way. 6% in venture means you must be loaded and spraying.
Yeah.
If
Right,
we're doing
yeah.
6%, that means, that's deep
yeah,
pockets.
the average in the market for co-investment funds is 8. For your
For PE,
reference.
you mean growth stage?
For co-investment funds.
Oh, okay,
Yeah.
interesting. Okay.
And over the past 12 months, our selectivity went to 3%. So we closed 3% of the reviewed opportunities. So for obvious reasons, in order to be a targeted region, you need to provide a lot of opportunities at the top of the funnel to be able to get at the end of the funnel. And that, to my point that I mentioned before, I wished we had a lot of deal flow coming from the region, because in turn, we will be able to be as selective as we are in the rest of the world and complete investments here. So
Yep.
it's really about that deal flow.
Awesome. So I want to open it up to the audience for a question or questions, just in case there's anything we didn't discuss or anything we didn't ask.
So just a very quick question. So you said, Benedetta, that you sort of invest in Asia, and now you're starting to do it in the GCC and the Middle East. What are the main differences that you see in investing patterns in Asia and the Middle East? What would you look at given an opportunity? Would you still deflect to Asia? Would you move towards the GCC? And what are some of the sectors that you're looking at in both these regions and how they're different?
So, to clarify, so we are very strong investor in Asia with a pan-Asia approach. Middle East is actually covered by both the European team and the Asia team, so we could have double coverage, but we are not there yet. So we've done only a couple of deals. Now, we apply the same screening processes to every company, wherever in the world. So in order for the Asia team to complete an investment, it needs to be all green checks across the entire checklist of our strategy. And it also means that our European team needs to like the same investment. Because at the end of the day, we have 3 teams, but they are part of the same investment team. And the deal flow is for the same fund. What do we look at? We look at growing companies that are growing before we acquire them via either like a combination of growth or buyout. By the way, the vast majority of transactions that we do are technically structured as buyout, even with no leverage. So it needs to be a growing company. It needs to be an innovative company in the way it does things. We really like emerging managers, so managers at their first, second, or third generation of fund, because we believe that they have a lot of scheming in the game, and we like the fact that we are taking exactly the same risk that they are taking. So you will see that we are pretty much the only co-investor with this strategy that want to take additional risk because we really believe that that's the opportunity. But among everything and above everything, I think it's very important to understand that we are co-investors much more than we are investors, which means that before investing in the fund, we like to do a co-investment with the same GP and see and use that opportunity to see how is their due diligence and how they perform under stress conditions. And believe that there's nothing worse than a due diligence for a transaction to test an individual. So that's how we like to do it. And from that, we have established incredibly long relationships with GPs and companies, thanks to just one co-investment at the very beginning for small tickets, 2 million, 5 million. We can go as low as 2 million in our flagship fund as well, $2 million. And we are the only one that can do that in our size of funds, obviously.
Thank you very
Thank
much,
you.
Amal and Benedetta.
Thank you, Ferris.
Thank
Thank
you
you,
so
Benedetta
much.
and Amal. A round of applause, please, for our
you.
panel
Thank you all.
this
Thank you,
afternoon.
GITEX.